You're about to watch the product review on Securian's Eclipse Accumulator IUL. Here we go. Hello YouTube, this is Brady Watkins, Leverage Wealth Management. We are taking a quick break from our series of generating tax-free income for life to bring a quick product review for you. One of these frequently asked questions is if we can review this Securian product. So just like every other product review, we are going to have one thing in mind as we're designing this policy. That's going to be max cash accumulation. We're using an asset reposition strategy in order to have income tax-free later in life. But really the point of these videos is to go through the actual ins and outs and bells and whistles of the actual product. That way we can kind of see what we're getting and if we are getting the best bang for your buck. So Securian is an A-rated company. They've been doing life insurance a long time, founded in 1880, a mutual company. And so from that perspective, this is a good company to go with. You want to go with carriers that are trusted and that actually have been doing this a really long time. So let's go ahead, without further ado, get into the policy. So let's go quickly into the indexing options of this product. They have what is essentially 4 different types of indexing options, 2 S&P based, 1 Euro stocks, and then 1 blended. They call it the Rainbow Indexed Account 1, which is basically a volatility controlled index that is blending all 3 of these based on performance, and the highest performing being the majority of the performance that year. As you can see, 50% of the highest performing account goes into that, 30% to the second, and 20% to the third. So that is the Rainbow account. This is a volatility controlled index to kind of get away from the ups and downs of the market. This is, super common with these IUL products. They typically have at least one volatility controlled index in order to give you a little less volatility inside of these accounts. So now as we're looking at the other options that aren't the volatility controlled, really this Rainbow, like I said, is just a mix of all 3. So I'm gonna go ahead and erase what I put here and just show you the indexing options. So the first one here is the indexed account A, the underlying index S&P 500. Current cap is 8.5%, participation rate 100%. And so that is the S&P 500, the most basic index. Typically, most carriers have this type of index here. The Euro Stocks index is a little bit higher of a cap. Same type of participation rate here, 100%. And the last one is an uncapped, low volatility S&P 500 index with obviously a lower participation rate. And so from what we see here, you have a few options here. The first one would be your standard straightforward S&P 500 index, which would be this first one. And the only one that is uncapped is this low volatility S&P, but it has a very low participation rate at 60%. Now, typically the volatility controlled indexes, which would be this Rainbow Indexed Account 1 in this scenario, typically has enhanced or limited participation rates. And here you can see it has the highest cap, pretty standard participation rate, but just gives you less of the up and downs of the market. And so what does this tell us about the carrier? It basically means that there's a lack of diversity and just quite frankly options. There's only 4 options here available for you to have. And so this severely limits your ability to diversify. And these cap rates are among the lowest in the industry here, all under 10%. There are much better options with different products. And so for that reason, I'm gonna give this product a C- in terms of indexing options. So one thing that's interesting about how Securian works their premiums going into the indexed accounts is they kind of take a different approach that only a few other carriers do. And what that is they allow your premium dollars to first enter this interim account that's gonna be credited daily until the policy reaches the 3rd Friday of the month, where it will subsequently go into the index account thereafter. And so this gives your dollars, a 2% boost as you're going into the account. Of course, you are waiting longer to be in the index account, and the policy anniversary for these types of credits will start when you actually went into the indexed account. You can see that here, the 3rd Friday of the month, 1 year later is when you get credited, and that's where you went in, the 3rd Friday of the month. And so that is something that Securian does A few other products do that, but there aren't really many in the industry. Let's talk policy loans. So we got three different options here in the form of policy loan provisions. And so we got the fixed interest rate, the indexed loan, and the variable interest rate loan. And so I'm going to break these down each one at a time. And so the fixed interest rate loan, or the wash loan, is very straightforward. You're going to get charged a 4% rate of the dollars that you loan out. And if you do that within 10 years, you're going to be credited 3%, and years 11 plus, you will be credited that same 4%, which is what we call a wash loan. Now, if you've watched any product review that we've done on this channel, you will know that one, every carrier has this wash loan in their provisions, and two, if your goal is max cash growth and income, this is not what you're hoping to put your loan dollars in, because you will lose the interest earning power of those dollars. So we did a full video on the different types of loan provisions inside of an IUL policy. I'm going to include that here. So if you're not using the wash loan, what loan should you use, especially as we're looking inside of this Securian policy? And that brings us to the next loan option that they have, the indexed loan option. And what happens to your loan amount that you take out? What happens to the dollars that you take out? It is transferred from your current fixed and indexed accounts into their chosen indexed loan account. Now, what does this mean? What this basically means is you lose the option to choose what your loan dollars are being invested in. So with this current policy and product, it will be going into what they call an indexed loan account. Do they disclose what the indexed loan account is on the policy? No. But we know that it's going to be the S&P based index that we saw as the first option here. So this is the indexed loan account that they will inevitably put your loan dollars inside of. You no longer have the option to choose between these four. When you loan out dollars using the indexed loan account, the S&P is your only option. Now, they have the ability to change that whenever they would like, but at the moment it is the indexed loan account. This current loan is at 5%, meaning it will be 5% fixed for the entire life of the policy, which is good. And again, going back to what I said, your rate that you're going to be credited of those dollars is no longer at your disposal. It is at their discretion being put into the index loan account. So the last one is the variable interest rate loan. Now, Securian has a slight difference between their variable loans than other carriers' variable loans. But let's go ahead and get into what this is. So what happens to your loan dollars? They remain in your current or fixed accounts, meaning you get to choose where you put those dollars continuously, even after you're loaning out your dollars. The rate that you're going to be charged is the variable part of this loan. It's going to vary based on Moody's corporate bond yield average, but it's going to be capped at a maximum of 1% above the fixed account crediting rates. Now, this is what Securian calls a soft cap, meaning it can't go over 1% above the fixed or wash loan rate charge, which right now is at 4%. That is subject to change. Obviously, we are in low interest rate environment, so it is nowhere near that 5% cap that it would be at currently. We are looking at 3 to 3.25 in variable loan interest rates for this Securian product. That is extremely good. Again, because we're in this low interest rate environment. But given these are long-term contracts, we know that interest rates are going to ebb and flow. But right now, given the low interest rate environment, this could be a great option to take advantage of if you were inside of this product. And we can see here, obviously it says this above a little bit, but your dollars are credited based on the performance of your chosen index accounts. You get to choose if you stay in the variable loan. So the downside to the variable interest rate loan, if you've seen any of our other videos, is just that, the variable. And with these types of policies, you really want to eliminate as many variables as possible. The reason we don't want these variable loan rates is because we want these policies to be as predictable as possible, leaving only the things that we can't control up to chance. And what those are is one, the index performance, and two, the ebb and flow of interest rates. So if we can control everything else, then we know that we have set ourselves up for success. So to give these loan provisions an overall grade, I would say a B+. Only thing that I would love for them to change is for the ability to keep your choice in this index loan. That would be a fixed participating loan without any type of hindrances. I will say another thing that's good about the Securian product is you have the ability to switch between these loan types once per year. A lot of carriers will limit you to 3 times total over the policy. You're able to switch in and out of these every single year. So getting to the policy ledger here, again, this is an asset reposition, putting in just over $1 million in as efficiently as possible in order to maximize tax-free income later in life. So this is a $150,000 annual premium for 7 years. This is a minimum death benefit design using the 5.47 illustrated rate that the policy will allow, and that generates $136,000 in income starting in year 18, and that goes tax-free for life with no market risk. So if we ended up having, a 30-year retirement or close to it, that would put us around, let's just say 94 because they total it up here for us. So for putting in this $1 million, this $136,000 annually has generated $4.5 million in tax-free income, and you're still left with a $500,000 death benefit. And so this is a phenomenal way to generate tax-efficient income with a remainder value that will be tax-free as well. So getting into Securian's bells and whistles, they offer this bonus interest credit on all of their IUL policies. And this is the fine print that's in the illustration, and it reads, Eclipse accumulator policies may receive a bonus and may continue to be paid out every year after the 11th policy year. Now, do they reveal what the percentage is that they are actually adding to your accumulation value? No, but we know it is a 75 basis point bonus. So that's 0.75% every year after the 11th year. However, we know it's not guaranteed to stay there, and it's not even guaranteed to be paying out every single year. So that's something to keep in mind as you're comparing different carriers and products' bonus interest methods. One, is it guaranteed at the amount that they have currently proposed? And 2, is it guaranteed at all to stay on the policy every year after? And I'll go a little bit further to even say that this wording every year after is even a stretch with this Securian product. Now, they won't say this on the illustration, but at the age of 91, your bonus interest credit starts decreasing by 10% until it gets down to 0. So is it paid every year thereafter? Not really. So overall, I kind of see what this Securian IUL product is trying to do. However, there are so many variables inside of this policy that 1, aren't guaranteed, or 2, aren't fixed for us to actually be able to set this up to where we have as many fixed and guaranteed features as possible. And for that reason, the overall grade I would give for this is a C+. I think they can do better with their indexing options, have a little bit more diversity. From a loan provision perspective, their variable loan with the soft cap is a great option. However, if you're choosing the fixed participating loan, you don't have the option to go in and out of indexes as you choose. That's a big knock on this product, given the fact that you're really getting control taken away from you and given back to the carrier. And if you compare this policy kind of apples to apples with the AIG product that we reviewed a few weeks back, even though it's not exact apples to apples, the AIG product is going to produce more income, and typically that's the way it's going to work almost every time. So the Securian Eclipse Accumulator IUL, certainly not one of the worst products in the industry. However, there are some things that need improved upon. I do, however, like the varying loan provision, that soft cap of 1% over the wash loan charge rate. I think that's pretty good. So if you have one of these products and you'd like them reviewed, or if you have any other product that you would like to review in terms of IULs or any cash value life insurance, I'm going to include a link below for you to grab some time with our team or to send in your policy directly. So we specialize in designing these policies for max cash growth and income. So this has been a product review for Securian. We'll be in touch next week, back with the series of generating tax-free income for life.